Good afternoon. Welcome to Wealth Capital Management's Q4 2025 Financial Markets Insights webinar. My name is Remington Borg, and I am the Portfolio Administrator here at Wealth Capital Management. I'll be your host, so if you have any questions during or after the presentation, please feel free to enter them into the chat, and I'll help facilitate responses. We are delighted to have you join us for what promises to be an engaging and informative discussion on the current state of financial markets and what it means for long-term investors. Our presenter is Cean Rogers. Cean holds the CFA designation and brings over 20 years of experience in the financial services industry. Throughout his career, he has guided clients through a wide range of market environments, helping them navigate both challenges and opportunities with a disciplined and research-driven approach. He structures portfolios across a broad range of asset classes and will provide a comprehensive perspective on the current investment landscape. In today's webinar, Cean will be covering topics including current economic trends that are shaping both the US and global markets, including recent economic data concerning the US labor market, key insights across major asset classes from equities and fixed income to alternative investments, as well as strategies for long-term investment success, grounded in fundamental analysis and prudent risk management. Whether you are a client, a market enthusiast, or simply seeking a clearer perspective on where we are and where we may be headed, we hope you leave with actionable insights and a deeper understanding of the value wealth brings to its clients. With that, please join me in welcoming Cean.
Thanks, Remy. And thanks everybody for joining our webinar this afternoon. It seems like every time we're doing one of these webinars, markets get a little bit more volatile and make our webinar a little bit more exciting the couple of days before. So it always keeps it exciting. So that's good. We'll start with talking a little bit about the global economy. Started with the IMF projections here. You can see world GDP projections is that we'll have growth of just over 3% worldwide. If we drill down and look at the United States, we expect a little bit slower growth, 2.1% for 2025, 2.4% for 2026, and 2% for 2027. And then you can see the other areas of the globe and where the IMF is predicting the growth rates. Since we live in the United States, that's probably where we want to start and what is most important to many of us here on the call. Q3 data shows that the US economy grew by 4.4%. Q4 data will be out later this month on the 20th. But we can get an estimate by looking at the Atlanta Fed's GDP Now forecast, which tells us that the expectation for growth in Q4 is 4.2%. Now, you may look at these last couple of prints and if we say 4.2 is going to be close to where it comes in, 3.8, 4.4, 4.2, those are pretty good growth numbers. But before we get too excited, we want to look at the purple bars here. These purple bars represent net exports. Historically, net exports have been less relevant. However, because of the tariff announcements by President Trump last year, and throughout this year and ongoing, many companies, especially early last year, shipped goods ahead of the announced April 1st tariff deadline and imported into the United States early to avoid potential tariffs. This led to a contraction in GDP in Q1 and a big negative net exports number shown here in the purple chart, followed by 2 quarters where we kind of made up for that. Inventories, shown here in the blue, did a very similar thing, but opposite. So we had a build in inventories, and then a drawdown in inventories, which added to GDP in Q1 and subtracted from GDP in Q2. One thing that during periods of time like this where we have a lot of noise in the data, sometimes it's good to look at core domestic demand, which takes the trade, the net exports, and takes the inventory data out. You can see here this teal line represents US core domestic demand. You can see that really the core domestic demand has been pretty stable over the last 2 years and has averaged right around 2.9%, whereas GDP, if we include the volatile sectors, still averaged about the same 2.8%, but the volatility is very uh, noticeable here in the chart. By far, the most important piece of GDP for the United States is the consumer. As the consumer goes, so does the US economy. Now, something that's going to happen in 2026 is we're going to have some benefits of the one big beautiful bill, or what we call OB3. We have some retroactive changes that happened in 2025 that will lead to larger than normal refunds, approximately $800 per filing, higher refunds. Refunds effectively are a one-time liquidity event. Estimates suggest $100 to $150 billion hits households during this tax filing season, with roughly 2/3 of that spent pretty quickly. That can add a few tenths to GDP for 2026, call it a 1/4%. However, this benefit will be front end loaded. So you'll see the benefit really more pronounced in Q1. We can see that here down in the bottom right corner of this chart. We have average income tax refund by filing year going back to 2009. And you can see that the number's usually right around $3,000 tax refund. And this year it's going to be closer to 4,000. So that's going to put some cash into people's pockets, and they're going to most likely go out and spend that pretty quickly here. So we're going to have a boost. We're going to have a tailwind to the US economy here in Q1 from tax refunds. Now you would think that that would make the consumer feel pretty good, but as you can see here, the Conference Board consumer confidence is at the lowest level we've seen since 2014, with sharp declines in both expectations and present situation, current conditions, to give us the lowest level we've seen since 2014. What this tells me is that the soft data, what consumers are feeling, is a little bit dislocated from some of the hard data, and we have a lot of cross currents that we're looking at right now. Usually, consumers feel pretty good if they have their job. That's a real important piece. Uh, and so that's why the Fed and others pay a lot of attention on what's happening in the job market, the labor market. You can see here the jobs harder to get, less the jobs plentiful. The spread is the highest spread we've seen since 2021. And you can see that generally, when that spread goes up, it tends to also mean that the unemployment rate will also go up. So that could be why consumer confidence is lower than we would expect. given where the economy is. We might have a less robust labor market than the unemployment rate itself might portend. Another thing that we like to look at is the savings rate and how consumers are acting. And right now, we have a very unique situation where consumers are saying what they're saying something, saying their confidence is shaken or their confidence is low, but they're doing something entirely different, which is they're spending they're they're spending a higher rate, and their savings rate is going down into a period of time when the unemployment rate is going up. Historically, when the unemployment rate rises, especially during bear markets, households rebuild savings. What's different this cycle is that savings have continued to fall even as unemployment has risen. That suggests consumers are supporting spending by drawing down savings, not because fundamentals are improving. This is unsustainable. And so we really want to make sure that we keep an eye on that. It means that future consumer spending uh, might not be as robust, and if that happens, we could have a growth slowdown slash scare. But that that's a tail, or that's a headwind, and then we've got the tax refunds, which is the tailwind. So you've got those forces kind of fighting each other. We have wage growth that has come down considerably since the labor market was really tight after COVID. So the wage growth is back down to 3.7%, and the unemployment rate is at 4.4%. On an absolute basis, we don't have January's numbers in, and they're not, usually they would come out tomorrow, but because we had a partial government shutdown, we won't get those numbers until next week, next Wednesday to be precise. This is definitely telling us that the labor market is not robust, but we really have to dive down and look at what's going on here. So hiring has significantly slowed since the beginning of 2025. Uh, this is due to a variety of factors. Some of it is due to productivity gains from AI, but uncertainty is part of the picture that has put a damper on hiring. Growth in the labor force has been impacted by policy changes, enforcements leading to a contraction in the growth of foreign born labor, a pretty significant contraction in the growth of foreign born labor. So you have your labor supply uh, lowering or not growing as fast. And so, in order to keep the unemployment rate, the number of jobs the US economy needs to add each month to keep the unemployment rate from rising has dropped dramatically, because labor force growth is slowing due to the demographic aging and lower net immigration. Economists now estimate that only 30,000 to 60,000 jobs per month might be enough to keep unemployment flat for 2026. Now, what we've seen in the last 3 months is a negative, is job loss. Although, if we look at December, we had a 50,000 job increase, but still the 3-month average was negative here, and you can see the trend is definitely lower. So next Wednesday's job number is going to be a very important number. This morning we had, and I actually think I have, well, where did I skipped one. Here we go. This morning we had US initial jobless claims come in much higher than expected, which started some of the sell-off today. You can see this, we were running closer to 200,000 and we spiked up about 22,000 this month. That's going to be a number that this number is very volatile, and it comes out every Thursday. And if we see a spike in initial claims, that's going to lead to the expectations that the labor market is worse than we think it is. Continuing claims had been elevated; they had come down, but you can see this morning they also spiked up a little bit. Now, these aren't one report is not a trend, so we want to make sure that we keep an eye on these. Um, but the labor market definitely seems to be weakening right now. Another item that came out this morning that spooked the markets is that the JOLTS report, the job openings, it's down to 6.5 million. That number right after COVID got up above 12 million. And one of the things that has happened recently is we now have more people unemployed than we do job openings. So this is all painting a picture that the jobs market is weakening, which brings us to the Fed. Labor market cross currents have complicated their policy decisions. You've got slowing labor force growth, lowers the job gains needed to sustain maximum employment. We've got modest payroll growth, uh, can coexist with with a stable unemployment rate. Inflation risks actually increasingly reflect labor supply constraints, not excess demand. The other thing that we're going to be looking at is we have a Fed chair change. Fed Powell, he was heavily reliant on forward guidance, the summary economic projections, and the dot plots, and communicating with the markets to smooth policy transitions, versus potentially where Warsh can come in with less communication, less signaling, and greater focus on long-term trends over monthly data. So we will see a little bit of a difference. The bigger thing, though, is that the policy destination is probably a lot more similar than what could have happened had President Trump chosen someone else besides Kevin Warsh. So we think Kevin Warsh is actually someone who has historically been more hawkish and instead of dovish, and it is a perplexing choice, given what President Trump's viewpoint has been up to this point, wanting lower interest rates. He may get lower interest rates in the short run, but Warsh is definitely an inflation hawk and is not dissimilar to Powell from a overall perspective. Something interesting to note is that leadership transactions historically coincide with periods of elevated market volatility. In fact, if we look at past transitions from one Fed chairperson, to another chairperson, you can see the average S&P 500 contraction during the first 6 months of the new Fed chairperson is about 15%. We see an average 15% contraction with the change of Fed chair. Now, with employment signals being blurred and by demographics, the second part of the Fed's dual mandate, inflation, becomes the more actionable side that the Fed is going to look at here. So moving on to inflation, inflation has fallen materially from the peak in 2022. The decline has been driven largely by energy and goods, not broad-based easing. Shelter and non-housing services continue to contribute disproportionately. You can see here dining, recreation, and other services, light blue, and shelter, dark blue. That makes up a big chunk of in the CPI increase each month over the last couple months. This month here is gray because we didn't have data. I believe that was October. Auto insurance, shelter, and services inflation highlight structural frictions rather than excess demand. With labor supply constrained, like we talked about earlier, inflation risks persist even as growth cools. This complicates policy. Inflation progress may stall without a sharp slowdown in activity. While realized inflation remains uneven, what ultimately matters for policy is whether expectations stay anchored. So expectations are very important, which brings us to break even inflation rates. You can see that the market has increased inflation expectations a little bit over the recent um, history, but for the most part, both the 5 and 10 year break evens remain near historical norms. Markets continue to price contain long run inflation despite near term stickiness. Stable break even suggests confidence in the Fed. Investors do not appear to expect return to a sustained above trend inflation. Anchored expectations give the Fed flexibility to be patient. Policy can remain restrictive without needing to respond to every inflation print. If inflation expectations are anchored, as we believe they are, the next question is how markets are pricing real assets. I'm sure everyone has, if you haven't, uh, gold and silver, precious metals in general, have been on a historic run. They were up a ton in 2025, and so far in 2026, with the exception of the past couple of days, they've continued that blistering run. We believe this is not necessarily an inflation story. Inflation expectations, like we showed you in the slide before, are anchored. So we believe the current run up in precious metals has more to do with debasement fears. Uh, Currency debasement reflects persistent deficits, which not only the U.S. but around the globe, we've got persistent deficits, large sovereign balance sheets, gradual erosion of real returns on cash and bonds. During a period like that, gold and other precious metals act as a hedge against long-term dilution, not near-term price increases. So again, we believe this has to do much more with debasement fears, not inflation fears. Over the long run, you can see here by this chart, over the long run, gold, especially if we were to take this last uh, exponential move here, gold tends to move very closely in line with inflation. A flat line across would be, a perfect inflation hedge. we don't get exactly that. Gold's return in nominal value has been 6.2% over the last almost 50 years, which is 2.6% higher than inflation. So it's giving you a little bit better than inflation over this period of time. But you can see that gold tends to move in powerful but uneven waves rather than straight lines. We had a huge inflation issue in the 80s. Gold had a very powerful rally, followed by a bubble popping, basically, and then consolidation, where gold basically kept with inflation until the great financial crisis, when we started printing money and we had debasement issues. We didn't have inflation issues back then, we had debasement issues, and you had another gold rally followed by uh, I don't know if I'd call it a pop of a bubble, but followed by consolidation. And then now you really have the debasement risks. Uh, but again, gold tends to move dramatically up and then follow by consolidation slash more in line with longer run inflation projections. So we want to know if we want to add gold into our, or any precious metal for that matter, we need to know why we're adding it. Adding it at these levels may not be so beneficial for future long-term returns, given the run up that we've seen in gold recently. All right, with that, we're going to move to global equity returns. Um, Global equity returns, we've seen a big shift. In 2025, the S&P 500 trailed, for the most part, global equity returns. You can see X world, I'm sorry, all country world X US, we had a 33.1% return in 2025. The S&P 500 did 17.9. 17.9 is great. 33.1 is fantastic. Developed international 31.9. The Eurozone was up over 40%. Emerging markets were up over 34%. And you can see this selected select countries here. The story is that the tide turned in 2025 with more uncertainty and investors finding attractive opportunities outside the United States, where valuations were not as stretched as inside the United States. That trend has continued in 2026. The US equities have underperformed the rest of the world by the widest margin for a January since 1994. A little more than 4 percentage points already in January, on top of what was already uh, about a 15% underperformance in 2025. A lot of that has to do with the US dollar. Looking at the US dollar, the greenback lost 10% in 2025. This is uh, coming on the heels of a 56% return since the great financial crisis. So we had a 56% strengthening in the dollar. American exceptionalism, American stocks doing absolutely fantastic. And you can see we've seen a pretty dramatic drop here, and maybe the start of a new trend. Dollar trends don't usually last just a couple of years. They last a little bit longer than that. And you can see we had a pretty big move in 2025, a 10% move, and so far in 2026 it's been a continuation of that. In the US, we still have a high concentration PE multiples have come down a little bit. They were, closer to 30 for the top 10 companies. They've come down a little bit here, especially over the last couple of days. Our market cap weighting has gone from over 40% to under 40%, but it's still very high. And then our earnings for the top 10 companies is just over 33%. So we still have concentration risk, in particular in the top 10 companies of the S&P 500. And we still have high valuations. No matter how you slice it, no matter which valuation metric you're looking at, uh, we're 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 not cheap at these levels. And I wanted to kind of just take a quicker look at a couple of these. At roughly 39 times, the Shiller Cape ratio is more than double its long run average and sits in the highest percentile of historical observations. Historically, periods starting from these valuation levels have been associated with long or lower long-term real returns going forward. Dividend yield is a very similar story. Dividend yields today are near the lowest level of the past 35 years. Outside of the 2000 tech bubble, we've rarely seen yields this compressed. And historically, these regimes coincide with elevated equity valuations. It makes perfect sense. Why do we care so much about valuations? Valuations over the short run, they don't tell us much. It's a crapshoot. If I know the valuation, I can't tell you much about the short term performance of an asset class. The longer you give me, the more important valuations become. If you give me 5 years looking forward and I have a valuation, I can give you a lot better guidance just given that valuation metric on what your future returns might look like. Still not perfect, but much more reliable. Let's look at earnings per share growth and profit margins. Earnings per share growth, analysts are expecting high uh, um, teens, 14, 15% growth in earnings per share over the next 2 years. If we look at profit margins are at basically historically high levels at 14%. There's a lot. I mean, it's just there's a lot of risk here at 14%. If we have a slowdown, if consumers start to feel like they need to uh, tighten the belt, it could put pressure on this profit margin, which could put pressure on earnings and ultimately put pressure on stock prices. Profits and employment. Uh, Headline profits, like we said, they look wonderful right now at 14%. Real inflation adjusted S&P 500 trailing earnings per share have risen steadily since 2024, reinforcing confidence that earnings can continue to support equities. The consensus is optimistic. Again, Wall Street expects about 15% nominal earnings per share growth in 2026, like we said in the previous slide, supported by the tax cuts and the refunds that consumers are going to get, supported by AI-driven productivity gains. A near-term earnings disappointment would likely catch investors off guard. Labor trends raise red flags. Despite strong profits, the S&P 500 employment has declined meaningfully since peaking in February 2020. I'm sorry, February 2025. Right here, it's this red line. That's company employment. So we've got profit margins in blue, and we have employment, and you can see that at the during last year, that employment number started coming down. History argues for caution in these situations. Since at least 1990, material job cuts among S&P 500 firms have often preceded or coincided with pressure on real earnings per share. The early 90s, early 2000s, the great financial crisis, 2016 and 17, and 2023 were examples of this. Um, it's possible firms are successfully boosting productivity through AI and automation, allowing them to maintain or grow earnings with fewer workers. So again, there's a lot of there's a lot of questions that we need answers to. Are job cuts a sign of true efficiency gains, or an early warning that profit growth may prove less durable than current expectations imply? Peak AI trade. Um, Over the last couple of days, we've had earnings announcements from both Alphabet and Amazon today, Amazon, and yesterday, Alphabet. They both reported massive amounts of CapEx spending projections. Uh, in fact, factors more than analysts were expecting. These numbers do not even include some of those increased CapEx spending that we've seen over the last 2 days. That's one of the reasons we've seen uh, prices and stocks come down so much, is because the massive amount of spending that's going to be needed in order to build out this AI infrastructure. And you can see here, even these are, a little dated. Um, we've got massive amounts of expenditures of CapEx. We don't start seeing the benefit of the revenues until later. And so there's a real impact on cash flow, on free cash flow. Um, it's still yet to be seen if these huge, massive CapEx spending is going to lead to the type of revenue growth that these companies believe can happen in the future. So there's a lot of questions, and we just want to make sure that we understand the risks. With valuations as high as they are, it just seems like things are priced, for perfection, and any little misstep that we have uh, could lead to a repricing, a revaluation of some of these companies. So we want to just make sure that we're real careful on what we own. I put this slide. I saw this slide, a couple quarter, like I think it was last quarter, and I just think it hits home right now. Um, these are the top 10 companies, the largest U.S. companies over different decades, and you can see that uh, the different decades are kind of shaded in a different color, so you can see easily that each decade the colors do not stay the same. In fact, they're constantly changing. And so the top 10 companies that we have today, JP Morgan, Berkshire, Broadcom, Tesla, Meta, Alphabet, Amazon, Microsoft, Nvidia, Apple, only 4 of those companies were the same companies 10 years ago. Microsoft was there, Apple was there, JP Morgan and Berkshire were there. These other 6 that are purple, they weren't even there 10 years ago. And going forward, when we get to 2035, it's likely that not a lot of these companies stay on this list. It's going to have a lot to do with who is successful with AI and who is not. If we're talking about the massive amounts of capex, if there's a winner, it could wipe out some of these companies, the amount of money that they're spending. So the point of the story is that the top 10 companies in the US changes over time, and you can't just buy companies and hold them forever. Uh, and not every company is successful. Global fixed income. Fixed income had a decent year in 2025. The ag was up just over 7% for 2025. The U.S. aggregate, and the global aggregate was up a little bit more than that, a little over 8%. Global fixed income returns benefited from a slightly lowering of the yield across the board in 2025. But you can see 2026, it's been pretty flat so far, to even a little negative, because yields have been pretty stable. In fact, the volatility of yields in the US is at a very low level compared to where we've been in the last couple of years. So a lot more stabilization in the yield curve. Credit spreads are extraordinarily tight, meaning we're not getting paid as much as we have historically for taking the same amount of risk. So again, these are valuations for the bond market. The lower the spread, uh, the less we're getting paid. So the less room for error we have. So we just want to be aware of that. The yield curve has steepened significantly over the last couple of years. This blue line right here is the current yield curve. And you can see where in July of 2023, we've had a massive shift downward in short-term rates and shift upward in long-term rates. And initially an over increase in long-term rates, and they've floated down since. Portfolio implications. Again, I think that we've seen a really big reversal of what's worked compared to the last, let's say, 15 years. This is the returns of several asset classes since October 31st, 2025. We've got commodities up 13%, small cap up 10%, developed international up 10%, emerging markets up almost 8%, global real estate up 5.5%, S&P 500 up an anemic 1% since October 31st, 2025. This is a complete reversal of what we've seen over the last couple of years, where the S&P 500 has outperformed all of these things considerably. Looking at long-term capital markets expectations, we can see that I just picked one, Vanguard. Vanguard, the dark green uh, chart or boxes represent the expected 10-year returns from these asset classes. So you can see US large cap has an expected return of just under 5% versus its historical 10-year performance. The last 10 years, the S&P 500 has given us more than 14% annualized returns. What Vanguard is saying, and makes a lot of sense given where valuations are, is that the next 10 years likely not going to give us the same 14.5, 15% returns that we've seen over the previous 10 years. The interesting thing on this slide here is that small caps, emerging markets, and developed equities have all their 10-year historical performance has all been bumped up because of 2025's performance and thus far 2026. Um, and you can see that Vanguard does think that US small cap is going to outperform US large cap, but not as much as maybe uh, it had before. We've had a little bit of run up now in small caps. Same with emerging markets, same with developed markets. It's all about valuations and expectations moving forward, and the starting point has a lot to do with that. From a wealth perspective, we in 2025 we were big fans of international, we were big fans of emerging markets, we were big fans of small cap. Now, because we've had great returns in 2025 and thus far in 2026, these areas that we had felt comfortable with putting capital to work, it is now that those areas are becoming less attractive because we've seen a run up in their prices. So we're running out of spots to put capital to work. They're still discounted compared to U.S. large cap, but they're definitely not as much of a home run as they were at the beginning of 2025. It's never this slide here. It's never about picking. You're never going to know which asset class is going to be the asset class to be in for the decade. It's more about trying to put your eggs in lots of baskets, uh, and benefiting inevitably from one of the asset classes or several of the asset classes that do well, and offsetting that with some asset classes that might not do so well. A 10-year period of time, if you had a lost decade, and I'd argue that the 2000s, the 70s and 60s for the S&P 500, these are unacceptable returns, um, for the amount of risk that we were taking by holding the S&P 500. Now, granted, if we held the S&P 500 for the entire period of time, we'd be happy, because that's an acceptable uh, return for the risk. The problem is we don't know which decade it's going to be at the beginning of the decade. So what do? I just took the lost decade for the S&P 500 and I said, okay, well, what if we were to own the S&P 500 along with some of these other asset classes? So we had some of our portfolio, in fact, 25% of our portfolio that lost 0.9%. But then we had 20% that earned 1.6. We had 20% in a piece of our portfolio that earned 10. We had 35% in bonds that earned 6, and we had 10% in real estate that earned 17. If we had that diversified portfolio, we would have a 5% return, which is a much more acceptable return level given the risk that we took to get that return. And we didn't have all of our eggs in one basket, losing money during that period of time. Now, I picked this period of time on purpose because it highlights a very important point about not having all of your eggs in one basket, and how by having them in different baskets, yes, you're not going to pick the asset class that did the best. You're not going to make 17% returns, but you're not going to also lose money during a 10-year period of time. You're going to be right down the middle. And in fact, I'm gonna go to this slide here. This is an asset allocation, very similar, not the exact same asset allocation portfolio that we just showed, but this shows your asset class returns for different years. and ranks them from worst to best, and it color codes them. So REITs are this baby blue, this light blue. S&P 500 is this green, and you can see that the colors are all over the place on this map. The only color that seems to always be kind of in the middle is this asset allocation portfolio. So if we're a golfer, we want to be right down the middle of this if this is a fairway. That asset allocate, we never know what's going to be on top and we never know what's going to be on the bottom. So if we own everything in a educated proportion, we can stay down the middle here and take unpleasant outcomes off the table. So that gets to that point there, the benefits of diversification. The other thing that we want to make sure that we really keep in mind is that stocks and bonds over short periods of time are volatile. The best stock market, the best S&P 500 year, up 52%. The worst year, down 37. If I have a 1-year time horizon and my worst situation is a minus 37 and my best situation is a plus 52, if I have a 1-year time horizon, I cannot take the risk that I'm going to lose 37% and be somewhere between negative 37 and positive 52. I can't even take the risk if I have only a 1-year period of time being all in bonds, because bonds, they had their worst year is minus 13%. We're investing to make money. If you have a 1, 2, even 3-year time horizon where you're going to need money from your portfolio, it better be in cash, or it better be or you better have a plan for it to be generated from dividends and interest from your portfolio to cover that cash flow need in that short period of time. If instead we have 5 years or longer, now we're starting to put the odds in our favor. In fact, if we have a 60-40 portfolio, there's never been a period of time where a 60-40, now 60-40 happens to be 60% S&P, 40% US aggregate. There's never been a 60-40 period of time. 60-40 portfolio has never lost money if you've given it 5 years. The worst 5-year period is plus 1%. So if we have 5+ years, now we can start to talk about, okay, now we can put some money to work in stocks and bonds. If you've got 20 years, now you really can take a lot more risk because you're putting the outcomes in your favor. The worst period of time over a 20-year rolling period of time for the S&P 500 is you made 6% per year. That's probably gonna be enough return for the risk that we're taking during that 20-year period. Now, of course, 6% would be a lousy 20-year return for the S&P 500, and we would expect hopefully more than that. But as a worst case scenario, if you've got 20 years, we can now go 100% in stocks. The whole point of this slide is you want to match your time frame with your risk level. Asset classes, just another way to look at the asset classes for 2025. So again, S&P was up almost 18%. Small caps were up almost 13. Here were our big winners right here. Developed international and emerging markets, almost 33 and just over 34. Real estate was only up 3.2%. Commodities helped in particular by precious metals. We're up almost 16% for the year. And then bonds on a risk adjusted basis, our bonds being up 7.3 and high yield being up 8.6 on a risk adjusted basis. Those are pretty good returns. We already went through this chart. So with that, I will open it up to Q&A. Remy, do we have any questions, or do we want to give the folks a couple of minutes to answer questions or ask questions, excuse me?
Right now, we have no questions in the question box, but we can definitely give folks a few minutes to think about any last minute questions they may have.
Okay, doesn't look like anybody has any questions. So with that, thank you all for joining us, and I'm sure we'll see you before then, but if we don't, we'll have another quarterly call in May, first Thursday in May. Thank you, everybody. Take care.